Oh, there we are.
All right. Kick us off, brother.
All right. Well, hi out there again, world. It's been a minute. The Whiskey and Wisdom boys are back at it with a coffee and confusion episode today. So a little bit of
Too early for whiskey.
Debatable. But to the confusion part of things, Mike, we want to dive right into this. We want to take up a bunch of people's time today, but we know over the past few months, we have seen a lot of volatility with the Federal Reserve raising interest rates and incremental hikes that have been occurring over the past 60 to 90 days. And obviously people are really paying attention to how that's having an impact on the broader economy. But there seems to be quite a bit of confusion on how that actually applies to the mortgage world and the real estate world. Because we've seen, obviously, they had a 3/4 of a point hike earlier this week from the Fed, but interest rates on 30-year mortgages actually went down. Can you explain that for us?
Yeah, so I absolutely can, and it'll be clear as mud, I promise. So you got to remember the Fed funds rate really is an indicator and a controller of short-term interest rates. And the economy at large is much broader and more convoluted than that, right? It is a series of levers, and controlling any lever could send something else up, something else down, something else up, something else down, depending on the context with which it's happening. And I know that, again, is clear as mud, but I can explain it this way. You've heard of the butterfly effect, right? Butterfly flaps its wings in New York, and in Tokyo, you get rain instead of sunshine. It's a little bit like that. So controlling the short-term rates, raising the Fed funds rate, means it's more expensive to do anything, buy anything in this economy. And if you go to the other side of the spectrum, what the enemy of bonds are, and again, bonds are where mortgage rates come from, is inflation. So inflation has much more of an impact on mortgage rates than the Fed funds rate does. So the series of levers I'm talking about in this particular case is the Fed raises Fed funds rate. This tells bond investors that finally they're freaking fighting inflation. They're freaking finally fighting inflation. And that makes them more comfortable to go and buy bonds. So they start buying bonds, including mortgage-backed securities. As they buy mortgage-backed securities, the price of those MBSs go up and the corresponding rates actually come down. So we are still, if you're a consumer out there and you're wondering, oh, interest rates are back, they're not where we were 6 months ago. Sorry, but they are better than we were 30 days ago and even 60 days ago at this point, thanks to that kind of series of fluctuations. Clear as mud?
Clear as mud. What particular mortgage products are affected by the bond market versus the rate hike from the Fed?
Well, they're all going to be affected. So any fixed term mortgage, even an ARM that has a fixed period for any length of time, is going to be affected by the bond market more so than the Fed funds rate. The longer the fixed period, the more affected it is by the bond market versus the Fed funds rate. The kind of lending products that are going to be affected by the Fed's fund rate moving is anything that's tied to prime rate. And those are going to be instantly adjustable mortgages or 1-year adjustable mortgages like home equity lines, credit cards, unsecured personal lines of credit, things like that. Anything with a short-term time horizon or anything that's immediately variable like that is going to pretty usually be tied to prime, which prime is tied to the Fed funds rate.
So if you've got some outstanding debt out there in credit cards or things of that nature, you might want to really look at some options right now based upon the raising rates from the Fed, correct?
Yeah, it's sort of the thing about the economy and the market these days is whatever you heard 30 days ago is wrong now. And it's kind of weird because things are moving so quickly now. And before I answer your question, to take a step back, pretty much everybody and their mom knew mortgage interest rates were going to go up this year, right? That was a pretty universally understood thing. What nobody, almost literally nobody anticipated was just how fast they were going to move. We were all prepared for a incremental rise in mortgage rates. What we got was doubling in 30 days. And that kind of caused chaos in the market. What question was I answering again?
It was about the credit cards. If you're carrying like a large balance in your credit cards or something that's got this higher interest rate where the Fed hike is actually going to increase your interest rate on that product, there may be some options there with the mortgage scenario right now.
Absolutely. So where I was going, thank you. 30 days ago, 60 days ago, that was not the case, right? Because short-term and long-term interest rates here have been varying inversely. So yeah, there's also been a situation where short-term rates actually went higher than long-term rates, which is an indicator of a recession, as we know, right? So 30 days ago, I would not have said that that was a hot topic. All of a sudden that's changed because short-term rates went up and long-term rates went down. So now used to be, 90 days ago, 120 days ago, it might have been a good time to convert short-term debt into fixed rate debt before mortgage rates went up, right? So it would have been a good time. Then boom, rates go up, not a good time because short-term rates are still low, long-term rates just doubled. Now, all of a sudden that gap is being bridged. And so now might be again, not still, but again, a good time to convert variable interest rate debt into fixed rate debt if it's tied to prime. On the other hand, on the mortgage side of things specifically, ARMs, whereas 120 days ago there was no benefit to doing an adjustable rate mortgage, now all of a sudden there's a huge benefit to doing an adjustable rate mortgage over a fixed rate loan. So they're sort of in tranches here by how short, how moderate, or how long term you're looking. Clear as mud?
Awesome. Not clear as mud, but it makes complete sense, as mud usually does. With the home buying public really trying to figure out what the best strategy is moving forward, right? For anyone who is looking to purchase real estate in this environment, what is the best piece of advice you can give them before we jump off of here?
Well, that has changed as well. I have been reminded over my 15-year career, not just in mortgage, but in real estate investing too, because remember, I do mortgages for a living, but as our CEO likes to say, mortgages are what we do, they're not who we are, right? And so really, I view myself as more of a real estate investor that does mortgages versus a mortgage person that tries to keep in touch with the market, right? So for me, this is going to sound self-serving and serving to you as well, but I'm back to buying real estate. I mean, I'm looking at this market. It was so hard over the last 2 years. And so many buyers have now, because rates went up and because of recession fears, have exited the market, right? So now all of a sudden, it's not the optimal time in history to buy, but it's the best time that you've had in 3 years. And with the demographic statistics that we're seeing, inventory, people growing up, leaving the house, there's just so many more buyers over the next 5 years, right? It gets fuzzy after 5 years, but at least for the next 5 years, there's going to be way more buyers than sellers in this market. And that means real estate prices are going to go up, right? So you're coming off of a time where it was almost impossible to buy a house. You're going into a time when real estate values are going to hold or even go up. And we're in this little window where, I would prefer that you go back in time and buy a house in 2018 or 2016. But since you can't do that, this is a really good time to be buying real estate because inventory is slowly starting to increase and buyer demand has, I don't know the number, but I would assume at this point it's been cut in half. The problem is that demand was at a 4-to-1 ratio with supply. So being cut in half still means there's more demand than supply, but it's a much better time than it has been. Does that make sense? Or did I rant?
Absolutely, because what we're seeing, to kind of maybe clarify your point a little bit there, is when people ask me, is there a slowdown in the market? I say yes, but it's not what you think that means. There's a slowdown meaning instead of 15 to 20 offers on a home, or maybe say 3 to 5 offers on a home. And homes that the sellers are being way too aggressive in their pricing are sitting on the market now and are now becoming ripe opportunities for buyers to take advantage maybe of a scenario where they can get into a home in a more normal, traditional contingency-based contract.
I've been preaching to my clients that yes, that is true, and you gotta separate the headline from the article, right? The headline is home prices are crashing, right? The reality, when you look at the details, is no, they're slowing their appreciation, but slowing down how fast you're going forward is still the opposite of going backwards. You're still not going backwards here. And I don't want to bore people with too much data, but there is one chart that I really think it's important to show, and I'll only show one. And it's because it explains why now might be a good time for you and why so much of your competition in buying real estate has gone to the sidelines to wait, is because they're letting headline fears push them into thinking that buying real estate is not a good decision right now because they think a recession's coming. And I think we're already in a recession. That's my opinion. I'm not an economist. I think we're in a recession that people are trying to spin. And I think one of the reasons they're trying to spin it is because I don't think it's going to be that bad. I think it's actually going to be a good, healthy correction type of recession that helps rebalance the market. But anyway, I want to share one quick chart, because when people think recession, they think the value of my home is going to crash. This chart, if you can see it, can you see the chart?
Yes.
This chart shows how real estate prices through the S&P Case-Shiller U.S. National House Price Index typically does through recessions. And if you look at all the recessions in recorded history since 1960 that we've had, the recession are these dark bars, and the white line is the average price of a home. Through almost every single recession, housing prices stay stable or go up. The problem is the most recent recollection that people have, and the one where, people that are you and I's age, this is when we were starting our career, starting our home buying, was 2008. And that was the one dramatic outlier. So this has the recency bias. These are much more normal recessions, and we can see home prices staying stable or going up. The reason this is such an outlier is because this was a recession caused by the housing crash. It wasn't a recession causing a housing crash. It was a housing crash causing a recession because people were doing, for lack of better terms, shady and over leveraged and risky. And we don't have to, recount the Big Short here, but this was an outlier, and it's what we all remember. And so it causes a little bit recency bias. And for our recorded history here of our lifetimes, it's what we remember, and it's pushing your competition to the sideline. So if you look at these parts of the chart, you kind of understand that real estate prices only go one way over time, except for that period of time, right? But in most case scenarios, buying here and selling here is a good thing. Buying here and selling here is a good thing. I think you get the point here, so I'm going to stop. But my mantra these days has been buy real estate and then buy more real estate.
Absolutely, because we're not going to see double-digit appreciation anymore, but we're still going to see pretty historical 2 to 4%.
We're going to see healthy levels of appreciation.
Correct.
That people can continue to hopefully afford versus everybody being priced out of the market because there's not enough houses. Still, that relies on more inventory being built, and that is yet to be seen how fast that can happen.
Absolutely. Great stuff, Mike. Love it. Any other points before we cut off here?
No, brother. I think we covered it. Thanks for giving me the opportunity to come on and speak.
Yeah. And as always, guys, Mike Swale with Fairway Mortgage. I'm Sean Hayes with Dealman Sotheby's International Realty. And if you're watching this after the live event, please feel free to still comment. We will be monitoring it, and we'll be happy to jump on and have any kind of conversations or answer any questions you guys have. Thanks a lot, and hope you guys enjoy your Saturday.